Welcome back to the Capital Mindset Show. We are your hosts, Austin and Fabio, and today we are going to be talking about Checkpoint Securities. We're going to be kind of discussing what the business is, what it does, who its customers are. We'll be plugging it into our discounted cash flow model, kind of taking a look at some of the numbers here. And then from there, without further ado, what are we looking at here today?
So first things first, again, we'll always look at the price action, see what's been going on with Checkpoint Securities. And what you can see here is they've been doing absolutely nothing for quite a while, right? So over the past 5 years, it's pretty much stagnation across the board. So I think the price movement is only up about 30%. Yep, exactly, 30.6%. A max performance, a lot better, but still not too great, right? Pretty good since IPO, about 3,000, 4,000%. Now, but the question is, what is going to happen going forward, right? We have a market capitalization of about 14 or 15 billion. And I think from here, we should discuss it's a cybersecurity company, and we're going to see if it's cheap, if it's good value. We'll see kind of the prospects. What are they going to highlight to us? So we'll go to the investor presentation.
Yeah, I was actually about to ask as well. What are some of the reasons for this current price stagnation too? What do you think some of the reasons could be here? Is this just
lack of growth? Yeah, lack of growth. So inability to really grow on the top and bottom line. But as we'll get over, it's more about a product shift that's going on at the company. So we have an investor presentation. Again, this is kind of like the sales pitch, but we want to see if there's anything that intrigues us, because if there's nothing that intrigues us during a sales pitch, that's a red flag. All right. So we see here, this is exactly what I'm talking about. The 5% growth rate. That's not good. That's not good enough. Okay. We have billings 9% and deferred revenues 12%. Okay. But we want to pay attention to this number. This is probably the number that kind of highlights exactly why the stagnation has occurred over the past 5 years. All right. So taking a look, for example, here, this is what I was going to talk about. This is the product shift that I wanted to highlight. So CloudGuard and Harmony. So they're actually integrating new different products into their services. And these are what's actually driving growth underneath everything. And this is actually one you want to pay attention to, because if it surfaces to the top and it starts to represent the majority and it continues its growth trajectory, then the story can change quite drastically.
Okay, so those products there that I just looked at, the Harmony and then the other one, what you're basically saying is those are two products that you want to pay specific attention to, because if those continue to do well, if they continue to grow, that could propel the growth of Checkpoint Securities further higher. Is that okay? Cool. Correct. Just want to make sure that I was understanding that correctly.
All right. So then in Checkpoint Infinity, this is the adoption rate. Okay. So this is, I think, a product that's kind of integrating their previous software solutions. But so this growth rate may be a little misleading because it's legacy customers that are also switching over to this. So it's not actually that accretive. That's why they're actually not putting any numbers in here. So that's kind of like a little note. So this actually to show you that they have broad diversification in the across the world. Okay. Yeah. And then let's take a look here. Revenues, gross profit, very high gross margin business. Very good. Yep. There it is. Gross profit of 89%.
You would typically see high gross margins in a business like this, correct? Because it's software. It deals with software, and software businesses typically tend to have higher gross margins.
Oh, but this is extraordinary. 89% is very good. It's about 10% more than other companies of typical in the industry.
Is that sustained over time though, or is that just when this presentation was put out?
We'll see in the model. That's just highlighted in this moment.
Okay.
All right. So R&D, they're spending about $62 million. Sorry. They're growing that at 17%. Good. I want to see that. Selling and marketing, they need this to drive growth.
Talking about R&D, why do you want to typically see R&D going up? Because people might look at this and see an expense going up and be like, wait a second, I don't want to see expenses going up. But in this instance, you just indicated that R&D going up is a good thing. Would you kind of touch on why that is?
So we want to make sure that we're talking about effective R&D, because you can just throw money away. Cool. You call it R&D. But you want to make sure that, one, the R&D is effective, and two, that you are taking it seriously. You want to innovate. You want to make the next best product. You got to take this stuff seriously. So we want to see spending on research and development. Added 250 employees. I don't really care. Could be, for all we know, just typewriters, right? No. I want to know maybe who'd you hire? So let's see, operating income, financial income, net income taxes. Okay, so tax rates remain about the same. And then net income. So net income actually went down. We'll see on a cash flow basis, EPS went up. Cash in net income went down, EPS went up. Okay. Why? They bought back shares. Very easy answer to that story. All right, cash flows, cash position. So cash, marketable securities, and short-term deposits, $3.8 billion. Very nice, right? Operating cash flow.
Where's most of that cash coming from, which we can later confirm too, because
Which one? This or this?
The 3.8 billion. How are they getting most of that cash? Is that most of that coming from operations or debt or equity, or it's just some questions that I have.
Not debt, not equity, operations. You know how I know? We'll see at their share counts, but it's been going down. They have a share repurchase program and they have no debt.
Nice.
So share repurchase program expansion of 2 billion up to 300 million a quarter. Ooh, very nice, because the market capitalization we saw was about 15 billion. So that's very aggressive buyback.
Okay, so actually, let me ask this question now. If you'll scroll back up just for a quick second, what is the correlation between this specific number, the 325 million, and then the 15 billion market cap? What is the correlation there? Because that kind of confused me. So could you kind of rephrase that a little bit, maybe?
Yeah. So the value of the business is 15 billion, around there, and they're buying up $325 million worth of stock a quarter. So yeah.
Okay. Okay, I get it now.
Yep. Gets to a sizable amount of the business they're buying back each year or each quarter. All right. So this is CEO and founder, by the way. I love how it's just a picture in the middle.
Yeah, it's just no name. It's just like this is it. This is all you're getting.
Yeah, pretty funny, but shows he's in charge though. When a guy can just say, I don't care.
Yeah, right.
All right. So the state of cybersecurity. So I don't care about this, just trying to hype me up. Hybrid cloud. Okay. Everywhere employee. Cool. Okay. So go show me that there.
Let me ask this now. Are you seeing any red flags currently?
No red flags.
And then obviously you've indicated multiple green flags, so I don't need to ask that.
So here's their Infinity solution that we were talking about before. So then they have CloudGuard, Quantum, Harmony, Infinity Vision. So I'm guessing this is all part of the same thing. And customer wins. Okay, so this is interesting. Customer wins. Looking through here, some
what does
big
customer
companies.
Wins mean? What
New
does
customers?
Mean? Okay, customer wins. Okay, it's late. I know. Sorry.
So Infinity gaining market traction. So this is again saying, oh, look, we're growing. Okay, I don't know what the numbers are, but again, it could be old customers, legacy customers now adopting the new product. Okay, so, we don't really care. And then if you guys can look here, so US, Infinity momentum across geographies and industries. So US, they're getting big in oil. Ooh, when we had a video about oil in the United States, if it's oil specific to the United States production, maybe, but incumbent players would be good.
Wait. Okay, so what is the connection here right now? Am I looking at a cybersecurity software that protects oil rigs, or protects oil companies, or protects oil software? Okay. All right, and then health services and it's medical
not
services. Okay.
Yeah, it's not too big of a deal here. All right, so superior management. Why checkpoint? So this is why they're trying to sell. So you say, please, not please, but like invest in us because of these reasons. So proven highest performance against competition. Okay, maybe. Consolidated solution, endpoint multi-cloud. So they go basically across the entire platform. Superior management. Okay, cool. Scalability. yeah, buzzwords. All right, Harmony. Okay, so I'm pretty much going to end here because this is just given this. What is this?
Talking about
fast growing cloud email. Okay, so cloud email. Okay,
but that's the So they've just diversified the business into email security as well.
Yeah.
So
and then so from there, let's just go on to the model.
Perfect. We're just
zipping through
today,
this,
aren't we? Oh yeah.
Yeah. So let's let the model scrape things in, and then let's give ourselves a 15% growth rate required.
Capital mindset standard. I love it.
Do that. And then let's assume a 4%. Okay. So while it's scraping in.
Well, do you think that at the current moment, and maybe the model will even tell us this, do you think at the current moment, management might be making these buybacks at a favorable point in time? Because I know for software industries, we typically like to see the present value of these future cash flows more than the price that it's currently trading at. Correct me if I'm wrong.
Yeah. So if we determine today that the stock price is undervalued based on the projections, then yes, we would want them to be doing the buybacks.
Okay. Yeah. Perfect.
Yes.
Awesome.
So, and it also will depend on the performance that it will yield if we get the buyback. So, no, we have to take that into consideration. So, they've averaged the growth at about 4%. So that's going to be our center. And then, yep, you see already there. It's good to go.
So, yep. Nice.
And then let's say they manage to accelerate growth in the future at 10%. And then let's do a middle point of 7.
Can we be a little bit more conservative on our buyback too? Just kind of put in maybe a 2% there just to kind of see.
And then let's do 1 and 2.
Actually, it's priced almost exactly at 7% growth.
Correct.
Almost. Yeah.
Yes.
With a 15% required rate of turn here.
Let's go back to 4, and then we would say we'd change this to 20, so discount it even more.
Yep. Oh my.
So here now you can see that we have to then assume that they're going to accelerate the growth rate going forward. Now we are assuming slightly lower buybacks than before. But yes, so if you want to discount it even heavier, about 20%, you may consider that to be too heavy of a discount. That's what we're looking at. And I want to highlight this number for everyone. So the analysts are saying hold and price target of 133.56, implying a 20.4% upside from here. A beta of 0.575, so it's not very volatile. And we confirmed that with looking at the price action in the past 5 years. It's not a very volatile company. So this is an interesting company, to say the least. It's not priced for any growth. If growth happens, this will be a very good investment. I can just tell you that. Because if, for example, if I show you, well, I mean, already showing you with the 10%. Let's
and then also, what are you looking at now that's really giving you that key indicator that should growth happen, this would be a fantastic investment? Because I'm kind of scanning this right now and I'm seeing, I'm kind of wondering now if GAAP net income is something that is pertinent to this specific business, or if you would place more emphasis on cash flows, et cetera, so forth. And then also too, if book value as well is something that really matters to you in this instance.
I don't care about book value. I'm caring just simply about the present value of future cash flows for this entity, and that alone, because again, we're in the software business. This is an Israeli company, so it is trading cheaply relative to other peers. I've discussed this in another video, how the United States right now relative to other countries is trading quite expensively. Now, I want to kind of highlight that if I don't assume the buybacks, you can see here, and again, this video is raw. We didn't look at it beforehand. It actually is not a buy. So a lot of the value returns are contingent on this amount. So, and again, that's with our massive discount. So if I can discount it at 20%, assume a 2% buyback, so about half, right? Then in that case, the story kind of changes a little bit. So from here, I can assume I think it's less than that. I can assume, let me see, 14.
Well, I mean, like what would also buyback. What in your thesis that you're developing right now, what's propelling this growth? Is it some of the acquisitions this company's been making? Is it some of the products that they currently have? If they can grow those products, grow the customers, if that customer growth is not legacy growth, but actual organic customer growth, are these all factors playing into this here right now?
Yeah, it is the potential that you could have some acceleration in growth. So, because again, this company is not priced for any growth whatsoever. If we go back to the 15% discount rate, and then let's actually go back to the 8%, you can see that if you're just discounting it at 15%, which is some consider that to be a hefty discount, 8% is all you really need with a 2% buyback, and you'll get that. And that's still pretty good returns. That's market beating returns. But if you want to discount it to account for maybe your greater uncertainty, you got to wait for a lower price than that. So again, we'll stick back to the 15. With the 15, I think we can go as low as 7%.
I actually think yeah, it is. It's right at 7% with
Mhm.
15%.
And that's assuming just half of the buybacks that they've been doing. So a lot of the value is contingent on them reducing the share count. And by reducing the share count, increasing your ownership of those future cash flows.
But that actually also explains why they're so bullish on buying back their shares right now, because there hasn't been a ton of growth in the price. So right now, the prices are actually favorable to buy back those
If they
shares.
think the growth is coming later, the CEO will be a lot wealthier if he buys back, because the CEO is also the founder. He actually owns a lot of the business.
Yeah.
He owns a decent chunk. I think it's about almost 20% of the business. And so if he's able to reduce the share count, increase his ownership stake in the business as a whole, now, before, let's say he thinks the growth rate's going to hit, that and that re-rating happens, then things are going to, change for the better. So
So
you might
no,
have
no,
to
no.
be,
Yeah, go.
this might be a stock that if one were to invest in it would have to be patient for that and pay attention to that, because it could be also easily dead money. So if growth rates subside and the growth rate actually maintains itself at about 4%, it's dead money. Okay. So do you see that? If
I
it grows
do.
at
And
the
like
average, it's
actually,
dead money.
where my mind immediately goes with this is, let's say I was to open a position in this today, this would be a speculation stock.
Yeah. And
This
if you,
this 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 would be a speculation play, basically. Are they paying a dividend right now? I have
no,
no idea.
no,
No?
no
Okay.
dividend. So no
Which
dividend, just
makes
buybacks.
sense because their ROIC is so high that I would actually prefer to have them keeping that cash in the business, because I'm not sure I can return 35%, and they're doing that right now.
Well,
So
actually, you don't even, by that same argument, you actually don't want them to have that many buybacks, right? Because they're returning capital. They're taking cash that could otherwise be invested. I'll highlight this right here. They could be invested, but they're actually putting a lot of that to the buyback. But that does tell me
interesting.
that they may be doing it efficiently. So they're giving you enough, right? But they probably could be keeping more cash than they really are giving out, right? So
That's
that's the assumption.
interesting.
Mm-hmm.
Okay. I mean, that makes
So,
sense when you explain it, but that is definitely interesting.
well, let's take a look at the
Okay.
key ratios and see if the ROE is kind of increasing over time. But look,
Wow. Look at
look
that
at the
gross
current
profit
ratio.
margin.
Oh
And
yeah,
also
it's
that
very
gross
high.
profit margin, it has been sustainable, to answer my question from earlier.
Yep, I
It's
told you you'd
been,
see it in the model.
yeah.
And then so current ratio, cash ratio, beautiful, very low debt. And then the solvency ratio, we can see there's no debt on the balance sheet, as you can see from here. So we don't really have to care about that. Total debt ratio, that's with their liabilities, but their actual long-term debt, they don't have any. And then gross profit margin has been sustainable over the course of the years. Operating margins have remained stable, declined a little bit. We want to see that coming back. Net profit margins have declined. We don't want to see that. And then ROE, ROA, good. ROE is actually improved. And then ROE has slightly declined. Sorry, ROA. But it's an asset-light business, so I'd actually pay attention more to ROE. So earnings quality. Earnings quality, we see it's good across the board. Remember, that's a capital mindset measurement. And then the free cash flow margin, fantastic. Wow. That's incredible.
So what is
Holy cow.
the free cash flow margin here? What kind of is that? And then what story are you extrapolating
Oh,
from
that's from
here?
the revenue. So that's from the sales. So of the sales, how much is actually coming out as cash money?
Oh my goodness.
That's, yeah,
Okay.
that's incredible. That's incredible. That's why
All right.
if
So
this thing has any growth, relative to like a software company, like the industry, oh, that's incredible. It's going to be a great investment. But
and
that's what's contingent on.
yep, and that also explains earlier too why you were saying if there will be growth, this will be a great investment. So you're kind of seeing the signs.
Mhm.
The signs are all pointing to, if
Potential.
there is growth, this could be a fantastic investment.
Yeah.
However, if there isn't, it's dead money,
If you
as you said.
somehow got this at book value, which I don't ever expect something like this to trade close to book value, but you
Mhm.
somehow did, that would just be extraordinarily cheap. But companies like this won't trade close to book value because they're software. So there's not really much book value. So if you're getting it at book value, that's like, wow, that's priced to death. But book value per share, we can take a look at this and kind of see what's the trend line. It's been increasing. It's larger than before, so that's generally good. But we don't pay too much credence to that for this industry. Price to free cash flow, the multiple has actually been declining slightly, probably because growth has subsided. And let's take a look at the well, we actually don't need to look at the activity ratios. So I guess we're done. And I think
kind of to summarize this, depending on your requirement for the business, for example, if you want to discount this at 12%, I'm not going to say you're good to go, because no, I'm not going to say that, but I would be good to go. I would be good to go with 12%, 13%. Okay, no, 13%. I'm not good. I'm basically good to go. If I require 13% rate of return, and then I'm assuming just a 2% buyback, which is about half of what they've done. So I will own more and more of the business by 2% each year. And that those cash flows going forward into the future is what I'll own. So if this is also your belief in the assumptions and your required rate of return, or my required return, I could say, you can see here, the model is telling me I could safely put 63.31% of my portfolio into it. But that's because
Wow.
it's assuming based off of all the risks. And if these assumptions are true, giving the probabilities, it's given an equal weighting, so 20% across the board, to each probability or scenario happening. Right. And then based on that, obviously, because for example, if you said this was 100% going to happen, it would probably be like, all right, why are you asking me? It's doing this because, there's a possibility that it's at a kind of a don't buy range. So watch this. If I change this to a negative 5%. So you see, because there is a possibility that you get this underperformance right here, it's telling me to lower my weighting, because it's 20% probable that a negative 5% happen. That's what I'm basically telling the model. So going back to a 4%, it's saying, okay, your risks are really low. That's what it's kind of telling you. It's a flagpole. It's not something to say you follow this to the T and you're good to go. No, that's not how it works. All right. So the discount rate, I think for this kind of company, I'd want to a 15% and above. And to imply that margin of safety in case I'm wrong, because I'm not a cybersecurity expert. Okay.
Yeah.
You have to understand your weaknesses. So
well, yeah. And that also kind of goes into exactly what we were talking about earlier, which is kind of knowing your weaknesses and knowing your strengths. And if you know your weaknesses, you can account for that in your margin of safety. So
but I want to highlight this. If they're able to buy back the same quantity of shares as they've done in the past, which they may very well do, then I can still assume a 4% growth rate, right? And get that 15% required rate of return. That's absolutely fantastic in my opinion. So I'd be interested in actually doing further research in this business and seeing whether or not it make it into my portfolio.
Okay. Well, just to wrap up the show here, I actually find this business interesting. I'm not sure I would really consider making this an investment. I would likely probably put this into the speculation bucket. But again, my portfolio is smaller, so I'm really kind of stringent about the stocks that I'm allowing into my portfolio. But with that being said, do you have any closing thoughts before I wrap up the show here today?
Well, that's pretty much it. If you guys have any other requests, put them down in the comments below, or go to our website at capitalmindset.org and then file the request there.
Yes, please. Well, we are your hosts, Austin and Fabio. This is the latest episode of the Capital Mindset Show. If you've liked what you've seen here today, please be sure to share the video. Really, really, really helps out the channel. Please be sure to like, comment, and subscribe. Visit our website, as Fabio just said, at capitalmindset.org, and we'll see you guys later. Take care.